I'm Charlotte McLeod with the Investing News Network, and here today with me is Adrian Day, President of Adrian Day Asset Management. Thank you so much for joining me today.
Well, thank you.
Yes. So let's start by talking about gold. Last time I checked, gold was up year to date, but quite a bit below 1,300.
Right.
So for you, where do you see gold going in the next few months and heading into 2018?
Well, you know, as with any market at any time, there's so many factors that are influencing gold at the moment. I think most of them in the long term, fundamentally, are very positive for gold. But, you know, in the short term, we've got hope, expectation. I think hope is perhaps a better word, that maybe Congress will pass a tax bill. If they pass a good tax bill that cuts taxes and simplifies taxes, that would be very, very positive for the U.S. economy, therefore, and also positive for the dollar, positive for stocks, and therefore negative for gold. So I think there's a little bit of concern about that. And also, you know, it's funny, this time of the year, October, is often a period when you see a little correction in gold after an August-September run-up, before a December, January, February, March run-up. So I'm not overly concerned about it. Fundamentally, I'm very bullish.
Okay. Any other catalysts that could impact gold going forward? We've got interest rates, we've got maybe new Fed president, geopolitical things going on.
You know, there's so many things that are going on and so many things that can influence. I mean, I'll go back to what I just said about the tax bill. If Congress passes a good tax bill, well, the contrary is also true. If Congress passes a bill that increases the deficit significantly, that will hurt, that'll make the Fed back off a little bit. It'll also be bad for the dollar and therefore positive for gold. On the other hand, if they fail to pass a bill altogether, that just shows more dysfunction in Congress, which is, again, positive for gold. So that's one thing. I think interest rates, you know, obviously gold has been concerned about the Fed tightening, quantitative tightening, but just as with the increase in interest rates, they've been extremely cautious. I think they're going to be very, very cautious in reducing their balance sheet. So I think gold immediately is concerned about quantitative tightening, but as time goes on, we'll see it's really not as scary as it appears.
Okay. So I watched your talk yesterday, and you talked about some of the negative impacts that very low interest rates can have. Do you mind going into that a little bit?
Well, sure. I mean, the problem is not so much low interest rates, it's artificially low interest rates. I mean, rates in the last couple of years around the world have been the lowest interest rates have ever been in the entire recorded history. That's quite a significant statement. And what happens when rates are artificially low is people who can borrow more. So, first of all, it hurts savers. So you have people who've saved all their life, don't have a lot of debt, have worked hard in retirement, and they just, their standard of living is just declining because they're not earning anything on their money. Or they start taking risk that is not appropriate for the person at their stage of life and their financial means, both of which are very, very negative socially and financially. On the other hand, the more wealthy people have the ability to borrow money. So when you can borrow money very, very cheaply, and you're well off, you do, and you borrow money to buy stocks. Margin debt is at record highs. The last time margin debt was anywhere near this high was at the beginning of 2007. We know what happened the following year, and the time before that was the year 2000, and we know what happened the year after that. So I guess in general, artificially low interest rates distorts everything. It makes people take actions that they wouldn't otherwise take. The little old lady speculating in the stock market, the wealthy guy borrowing money to buy extra stocks and so on. And all of these will have negative consequences when rates turn.
So if you're an investor, there's so much going on right now. What should your approach be?
We in our management program, we have quite a lot in the stock market, and we're not panicking to get out. But I do think the risk has increased significantly in the stock market, and we are certainly not, with very few exceptions, very unusual circumstances, we are not buying the U.S. stock market at the moment. I just think it's far, far, far too expensive, and the risk is too high. And of course, when a manager talks about risk reward, he's not making a prediction that the market will turn down or will crash. I'm simply simply saying that the risk is too high to be investing right now. We are looking abroad. There's some good buys, particularly in Asia, the established markets in Asia, Hong Kong, Singapore. You know, you can get really good quality companies yielding 4, 5, 6%, and trading in single-digit PEs still. So there's some good values over there for people who want income. And then we're also buying both some of the base metal commodities, particularly copper, although they've had a bit of a run-up, so we're a little cautious right now, today. And then we're buying gold stocks. The gold stocks are incredibly depressed in my mind, just incredibly depressed. If gold is cheap relative to the other financial assets like stocks and bonds, gold stocks are even cheaper because they're cheap relative to gold on a fundamental basis, on a price basis. So I think the gold stocks are extremely good value right now.
Great. Do you have any specific examples you could mention?
Well, yes. I always hate doing that because, you know, you've got to talk to a person about what are your circumstances, what are you trying to achieve. I always say to people, if you only want to buy one gold stock and just buy it and forget about it, I think Franco-Nevada is the one to buy. Now, if you're a trader, I would say Franco-Nevada is perhaps a little bit expensive right now. But if you want to buy one gold stock and forget about it, Franco-Nevada is a blue chip of all blue chips. There's many juniors that are very good value right now. I mean, some of the prospect generators, which have a low business model, low risk business model, are very cheap. I like Evrim, EVM, on Toronto. That's about 24 cents right now. I think they're almost giving it away and it's well cashed up. Riverside is another one, 28 cents, 29 cents. RRI on Toronto. And again, very good balance sheet. They raised some money earlier in the year, last year. Evrim raised some at the beginning of this year. So both of those two are very well cashed up, so you don't have to worry about another financing any time in the near term. And yet they have JVs with several companies in each case. I like both of those. Very, very good.
Great. All right, last question. So you've talked before about the risks of investing in gold producers and things like that. Last month, or earlier this month, we had Paulson & Co. come and say, okay, maybe we should have a group of people who tells them kind of what they should be doing. Do you like that idea? Does that make it less risky and better?
I do like the idea with a few caveats. I mean, I think the Paulson Group, they're absolutely correct in saying that the senior mining companies have had awful returns on the money that we give them. Not only over the short term, but over the long term. I did a study once that showed over the last 40 years, the gold mining business has the second worst returns of any industry in the world, and the worst was the airlines. And there's something that's similar about both of those. But in the gold mining business, you do have inherent difficulties. You know, it's a very, very capital-intensive business. It takes a long time after discovery. The odds of discovery are low. After discovery, before you put something into production, is a long time with environmental and permits and everything else. And then once you've built the mine, you've sunk $1 billion into Tanzania or something, the government can come along and say, hey, now you're here and you've spent the money, we'd like a little more of that. So inherently, it's a difficult business. But I do think the gold mining managements, and this is the point Paulson was making, have really exacerbated the problems by being pro-cyclical. Now, pro sounds a good thing, but when you're investing, it's a bad thing. The gold mining companies, with few exceptions, Franco-Nevada being one that I mentioned earlier, typically have been overpaying for marginal properties at the top. And you look, and then not buying at the bottom. Very few companies, relatively, very few companies were buying anything in 2013, 14, 15 when the prices were low. Companies were on the edge of bankruptcy. You could have stolen projects. But companies were selling their own assets and reducing their debt. The time to take on debt is at the bottom, which is what Franco did. First time in his 40-year history, it took on debt in 2015, I think it was, at the end of 15, to buy an asset they wanted. But not at the top. You don't take on debt at the top when things are expensive to overpay. And so I think they're absolutely right in that. And they had a stunning chart. Did you do an interview with him?
No, I didn't get the chance to.
They had a stunning chart that showed that of the capital that had been deployed they had a list of about 20 senior companies in 2010, 11, and 12. A majority of that has now been written off We're not talking about they haven't earned the money back yet. You would expect that because it takes a long time in mining to earn the money back. We're talking about they have written off a majority of the money that they spent on acquisitions in those years. I mean, that's just an astonishing fact. So getting a group together, notwithstanding all the legal problems of, conspiracy and all that, collusion, but getting a group together to say, look, you've got to stop, wasting your money on marginal assets at the top of the market when prices are high. Now, we're not at that point now, but being more shareholder friendly, cutting salaries when things aren't doing well, what a novel idea. So I think it's a good idea, yeah.
Okay. All right, that was all from me.
Oh,
that was great. No.
Thank you very much.
Okay, yes,
thank you,
thanks
and thank you for having me.
Yes, and once again, I'm Charlotte McLeod, and this is Adrian Day.